Good morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth. And this week, welcome back to Tom Hibbert from our Chief Investment Office.
Hello, everyone.
Morning. As you know, Tom, we are here to cut through all the noise in what's going on in the markets and hopefully demystify it in a simple and easy to understand manner so that you can feel more informed, more confident and more in control of your financial future. Okay, so this week we're unpacking the renewed pressure in the UK markets, which has been particularly driven by all the political uncertainty that's going on at home.
Absolutely,
so
yes.
Can you just tell us a little bit more about what's going on and why the markets are under pressure, particularly UK gilts, and should investors be concerned?
Yeah, and I mean, job security at number 10 is not looking great at the moment,
not great
is
at
it?
all,
So
no.
there's that, but it's happened at a bad time for the bond markets because globally, bond markets are facing selling pressure. There's upward pressure on yields. UK gilts then are under pressure on multiple fronts.
Right.
And, you've got this rising political risk premium after Labour's rout at the elections a couple of weeks ago, a deteriorating fiscal backdrop largely attached to that, a heightened sensitivity to the global energy crisis, as I've mentioned.
Which we've been talking about the last few weeks.
Yeah, and this stagnating economic growth backdrop as well in the UK. And also you add to that the fact that we've already gone through this big inflation wave and UK consumers have lost about a third of their purchasing power since 2021. So yields have risen to their highest levels since 1998. If you look at the 10-year yield, it closed last week, 5.17%. The pound as well under renewed pressure. So the pound fell 2% against the dollar last week. So that's why gilts are facing this pressure.
Yeah. So all in all, higher borrowing costs and a weaker currency all sounds pretty serious.
It does. And look, there have been places where the market is more robust, and particularly where we focus for portfolios.
Okay.
We do look at shorter maturities, and if you look at the Bloomberg's 1 to 5 year gilt index, it's only fallen 0.5%.
So are the markets being too pessimistic then, do you think?
I think they are. To be pricing in 3 interest rate hikes seems quite pessimistic. I mean, there is obviously a risk because the fact that you've got yields rising across the curve now on the back of this political turmoil, and the market is obviously worried about who's going to replace Starmer if Starmer does step down, and there are a number of candidates that might concern markets. But again, if you see yields start to rise too significantly from here, the impact on the UK economy is quite stark. I mean, you get to the 10-year yield pushing 6%, and it has some pretty serious consequences for the broader economy.
How high could yields go? And what is the impact on the UK economy then? And ultimately, I guess, as we're seeing here, it's for investors.
Yeah, exactly. And it's a difficult question to answer because there are so many moving parts. Yeah. Okay, well, I'll do my best.
Do your best. Go on.
I say if you've got the 10-year gilt yield at the moment is 5.17%, or at the end of last week, yields are down a little bit today, speaking on Monday. If that yield pushes 6%, the UK is likely to enter into a sort of technical recession.
Right.
It has an impact on mortgage costs. It has an impact on corporate borrowing costs. You enter. I mean, also yields need to stay elevated at those levels. Yeah. And I think we're more likely to see yields rise and then come back down pretty quickly because of the growth implications. But if you look at a really bear case scenario and yields do stay high, I think 6% is the level where you start to see sort of recessionary outcomes for the UK economy. 7% yields imply a much more deep recession and a really quite a serious fiscal crisis for the UK government. So those levels are worrisome, and you can obviously get to those levels on yields, but I think at those levels you'd have more to worry about than.
So, what could potentially offset those risks and those high yields?
Sure. I mean, the first is that yields fluctuate quite naturally. I say that the cure to higher prices is high prices. Yeah. And I think if you start to see yields reach those levels, the UK economy the implications for the UK economy will result in a sort of a falling bond yields again.
So sort of self-correcting.
Potential, I think so. Yes,
Yeah.
I mean there are some push and pull factors that are a bit concerning, but the other thing is the Bank of England has, and the DMO, the Debt Management Office, have levers that they can pull to support the bond market. I mean, the Bank of England is the only central bank that's still doing quantitative tightening. They could stop that.
Remind us, quantitative
that
tightening.
means they're reducing the size of their balance sheet.
Okay.
So they're actively selling bonds back into the market at the same time as you've got tons of selling pressure on bonds. So they could easily halt that to reduce the pressure.
Okay.
The Debt Management Office.
And if they did do that though, if they halted selling bonds, what would the implication be?
It means that there's less of supply on the market.
Okay.
So it reduces the upward pressure on bond yields.
Okay.
And at the same time, the Debt Management Office, they're already talking about...
I didn't even know there was a thing called the Debt Management Office, so there you go.
Yeah, they're responsible for issuing gilts. They are likely to increase their focus on issuance at the short term, shorter dated maturities, which lowers the borrowing costs for the UK government, and it reduces the pressure at the most vulnerable points on the yield curve, which are the longer dated maturities, sort of 15 to 30 years.
So bringing that all together then, what's our base case on all of this at Canaccord, and how are we positioning portfolios for clients?
It's a good question. And, I think given the growth implications and the fact the market is focusing much more on the inflation, I think the Bank of England are more likely to be on hold. I think the Barter raising rates is quite high. Yeah, they might hike rates in Q2, maybe Q3. This year, but I think that would be a policy error given the negative momentum for the economy. And yes, the bond market does look vulnerable today. We don't believe that a further rise in yields will be particularly persistent, as I said, because of these sort of the offsetting factors, and given the implications for the economy. But it is important to understand the potential economic implications for a further and persistent rise in yields. Yeah. And I think that that is sort of the levels. If you look at 6 and 7% yields, those have either recessionary at 6% and deep recessionary consequences at 7%.
So how does that reflect back into clients' portfolios then? What are we looking at there? Yeah,
well, most clients, hopefully, I mean, particularly if they're paying taxes, gilts are very tax efficient. Yeah. Hold them to maturity, focus on shorter dated maturities. They're a really interesting asset class at the moment, or investment option at the moment. Also, I think given the fact that yields are high, the return outlook from here is quite asymmetric.
Asymmetric meaning?
That your upside is bigger than your downside.
Okay.
That's the nature of bond mathematics. But you have this buffer of the starting yield when you buy a bond.
Yeah.
So if you buy a bond with a 5% yield, it takes yields to further rise quite a lot before you actually generate a negative return on a 1 year view.
So let me sum up then what's in my Canaccord takeaway coffee cup this week. So there is no doubt that the UK is under pressure, and markets are demanding a higher premium for the risk they are taking, which is pushing borrowing costs higher and testing investor confidence, all related really to this political risk, but also inflation and rising global yields. As ever, the outlook feels uncertain, but potentially higher yields are also a resetting opportunity, particularly for those sort of disciplined long-term investors, and potentially for those people who are higher rate taxpayers, potentially an opportunity, but in short term.
I would say so. And, you don't have to put all of your eggs in the gilt basket.
No, definitely
not. You have some small exposure, particularly when there are obvious potential risks, and the gilt market is vulnerable. But also quite good value today.
Great. Thank you very much. Thank you for your time, and thank you for listening to the Canaccord Coffee Break podcast today. If you've enjoyed it, don't forget to hit follow on Spotify, Apple, or your podcast channel of choice, and you'll never miss an episode. And as always, we'd love to hear your thoughts, or drop us a line, ask some questions to coffeebreak@canaccord.com. Thank you.
Thanks very much, everyone.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.